Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Jeff Kilburg, founder and CEO of KKM Financial, as well as Dan Deming, managing partner at KKM Financial. They join me to discuss the fundamental factors impacting the macro environment and the market's response. Gentlemen, it's great to see you as always. Welcome back to Trade Talks. Jeff, I want to kick this off with you, and it's a good time to think about macro fundamentals as we are largely out of earnings season. We're in that vacuum again. And of course, the market is going to be fixated on what's happening with the Fed, what's happening with the labor market, what's happening with inflation.
It's amazing, Joe. And inside this conversation, we're continuing to see new all-time highs, not just in the S&P 500, but also in the Nasdaq 100. So this has been a really interesting day because in the wake of the jobs report, which was kind of a mixed bag, especially in take that revision they had in January, I think the global macro fundamental has been really AI fueled. And we continue to see this AI domination. It's the theme we embraced in 2023. We're seeing it again in 2024 as these markets are off to the races. But today, as we've seen NVIDIA move from the last two earnings reports up about $400, it almost tested $1,000 today. 974 is the high, and now we're $100 lower. So in a matter of just a couple hours, everyone is now questioning this AI-fueled rally because the AI darling, the leading chip maker, NVIDIA, is all of a sudden showing a little bit of reality coming back down. But it has been sensational. I think a lot of people are unpacking, and maybe Dan can even add in because we're seeing so much volatility subdue lately. And just in the last trading session, we're seeing an implosion or explosion of volatility.
Yeah, absolutely, Jeff. As you pointed out, the reaction to the jobs number, certainly when we came in this morning, we did see the futures lower. Positive reaction to jobs data, but as we worked through the morning session, the shift in the AI space, the shift in the semis has certainly had its impact in the market, and now we are seeing the volatility creeping higher. Now, you look at the VIX over the last couple of weeks, we are trending in a higher direction, and even throughout this week, the intraday volatility in the market continues to ramp up, and that's, I think, driving the implied vol level of the VIX as to why we're seeing the VIX now trading above 15 for the first time really since the middle of February. And as we continue to realize increased intraday volatility, you would expect that that's going to have an impact on implied levels as we move into next week, which is expiration week.
Yeah, right. And just to add on quickly, Jill, I think understanding volatility, which Dan understands volatility better than most, but understanding where volatility is coming from is so critical for not just the retail investor, but also institutional investors. So to see a subdued VIX in layman's terms, under 13, now back above 15, doesn't feel like a big move. But since it's been so subdued, while we've seen November, December, January, and February of S&P 500 markets moving higher, I think this is a big deal and should be catching more attention, specifically as interest rates have been coming down since Fed Chairman Powell was talking about we're going to do rate cuts at some point this year.
Right. And Dan, we've seen this before when vol is exceptionally low, the move to the upside certainly feels more profound. But, and something else that we've seen before is when you see the S&P and the VIX moving in tandem higher, it generally is an indication that investors are a bit nervous out there. And we kind of saw that going into the beginning of this week. And again, it also aligns to what I mentioned on the top. Now that we're coming out of earnings season and hyper-focused again on what's happening with the macro, and of course, everyone's talking about fiscal policy as well, it's just kind of aligning well with what's happening on the calendar too.
Agreed. I mean, typically that inflection point of a higher VIX along with a higher market is something that can, indicate that a short-term top at the minimum. And, that certainly seems to be the case right now. Now, next week, we have several data points that are going to influence the market and the inflation front. And of course, we know the Fed watches that very closely. So you got CPI, PPI, and retail sales next week as far as the big data points, as well as Fed speak throughout the week and expiration underneath the surface of all that. So again, Jill, as you pointed out, and, when you do see the VIX creeping higher into a higher market, that typically is indication that there's a lot of hedging going on. A lot of market participants feel that there's some potential downside to the market. And we'll have to see after the selling pressure today if that persists next week.
Right. And Jeff, another part of the narrative for 2024 has been concentration risk in a handful of stocks that have really had influence over the market. That being the tech sector. Has that trade played itself out? Is there, if you think about it near term or longer term, or is there still money that can be put to work there?
I think there's still money can be put to work there. I don't think it's overplayed. I just think it's overbought. And when you see the Magnificent Seven, all of a sudden those constituents in the S&P 500 become 30% of the S&P 500, there's vulnerability there. However, that market cap component has led the market higher in the last 4 months. But as you know, Joe, we've been in these markets for a long time. Nothing's linear. Nothing goes in a straight line. So the fact that we continue to see, I think we're on our 16th or 17th new all-time high for the S&P 500 just in 2024, that type of melt up feeling, maybe it's been a gamma squeeze just in the video, whatever the input has been, it doesn't feel normal. And that's where I think people are getting a little bit nervous. But on the flip side, you're seeing a lot of the cash hoarders. We're seeing almost $8 trillion in cash on the sideline. They're scratching their head contemplating, and they've been chasing this rally as the S&P 500 almost kissed 5,200 today.
Yeah, I mean, it's almost like a self-fulfilling prophecy, because if you're benching right to the S&P, or especially if you're benching to the Nasdaq 100, I mean, you almost, Dan, you have to own these things.
Absolutely. And as you pointed out, that, the other thing I think that needs to be pointed out here is the rotation that we are experiencing the markets. If you look at the small caps, even today, just down slightly with the rest of the market under some significant selling pressure. So, when you look at just relative performance over the last couple of months, yes, the Magnificent Seven have captured the headlines, rightly so, but really the strength now is continuing to move out and kind of work its way through the markets into other sectors that have been underperforming. And you look at the small caps in the last couple of months, particularly over the last week, you're seeing some significant outperformance there. So there is a broadening of this rally, even if we do see some selling pressure. It does feel like there's there is a rotation taking place underneath the market as some of the big Magnificent Seven names come off, particularly when you look at Apple as well as Google, and underperforming to this point.
Yeah, and just to add on, Jill, I think Dan brings up a great point, that broadening component in the small caps. But you're also seeing names when we talk about this AI-fueled rally. You haven't really seen Intel participate. At some moment in time, there is going to be competition. If it's AMD, if it's Intel, if it's some other semiconductor provider, that they're not going to let NVIDIA make chips for $2,500 and sell them for $35,000. We've seen fees and compression across the board in any asset class, any sector. So I think you're going to see NVIDIA have some form or fashion of competition, which could bring them back down to earth. And if you look at the 50-day moving average on NVIDIA, it's down around 600, 625, which is just remarkable to see that parabolic move. You've seen NVIDIA add $1 trillion in market cap in just the last 10 weeks. $1 trillion. They leapfrogged Amazon, Google, Meta, all these different names to be the third largest company in the world, above Saudi Aramco. So I think there's just a lot to digest there. But these spastic parabolic moves always provide opportunity for traders. They do unsettle some of the nerves, though, of investors.
Yeah, and Dan, to Jeff's point, even if the market goes up or down as an options trader, you want some volatility back in the market when you're thinking about it from the day trader, swing trader perspective. This week has been good for that.
Yeah, absolutely. Yeah, you've seen dispersion in single list names as well as the various sectors, and the increased intraday volatility as well, Jill, that needs to be pointed out. Now, if you look at realized volatility on any metric over the last 10 to say 30 days, it's still pretty low from a historical perspective, but there's no question when you look at the price action within the intraday moves in the market and the reaction to some of the Fed narrative as well as the data points. And even today, when we did see the markets higher significantly early in the session and then reversing lower, that sets up for what could be a potential very volatile expiration week. And again, as a trader, that's one thing that you like to see is the opportunity to, again, scalp gamma or, trade some of these moves and have the opportunity to get in and out of positions and not have to deal with the decay.
Jeff, let's stay on the options conversation for one more moment here with the infiltration of products that we've seen, especially zero-dated options that are coming on. Do you think that has skewed the activity, if you will, pardon the pun, of options activity that we do see on, the quarterly quad witch, triple witch expirations? Have the proliferation of products coming on impacted how options expiration functions? Because it's daily.
Unequivocally, I would say the influence that they have had, and you're seeing more and more participants try to understand and how to utilize, because if you think about options, options have been available to institutional investors, traders, like ourselves, but that's kind of been like a really select group of people who have had access to options. Now, in the last couple of years, the education of options, the utilize of options has really grown from a year-over-year perspective. So when you see the amount of options being traded in those zero-dated options, that absolutely is influence, and that's making more volatility. So it's the vol of vol. It's wonderful for traders, but if you're a long-term investor, just put it on a leap going out a year, there's more volatility in that leap than there's ever been before because of all the undercurrents of different options trading, if it's weeklies, if it's zero dated, or if it's monthly, quarterlies. It's just, I think it's phenomenal that people have access to the tools, but it's absolutely influenced, and it's an exaggerating move. When you think about a pendulum going from one side to the other, it's moving that pendulum maybe further than it should be, but it's also providing opportunity for hedgers and traders.
Yeah, I think it's also certainly impacting intraday volatility that is not necessarily measured, but yes, it certainly seems to be impacting intraday volatility in single list names as well as some of the indexes.
Yeah, let's switch gears for a moment here, Jeff. Talk about any signals that you're seeing in the fixed income space. Certainly you're under stripes in the bond pit, so you're one of my go-to experts here. Anything that the fixed income space is signaling in terms of how it's processing what's happening with the macro?
I think the sensitivity and interest rates to what Fed Chairman Powell's been talking about, specifically in the last month, because he went on 60 Minutes, let's remember, a month ago, because he really wanted to pound the microphone and let people know that they were not going to be cutting interest rates in March or anytime soon. Now, all of a sudden, this week, we kind of feel like he was setting the stage for 25 basis points to be cut in June. But what's fascinating to me is that we were at 375 to start the year, went up to 430 in the wake of the fact that we weren't going to get these rate cuts till later in the year. Well, now we're not going to get them later in the year. Maybe we don't get 100 basis points. Maybe we only get 50 because it is an election year. And you haven't seen the sensitivity. You've seen the bond market, the 10-year note specifically, come down a little bit in yield, up in futures prices, but it just doesn't seem as sensitive to it was, or the Fed rhetoric like it was prior to 2024. So I think that's a way of the bond market telling the Fed, you're going to have to start cutting rates, but we're going to be patient with you. So it's interesting to see that ebb and flow.
Yeah, and when we think about the equity market, we're continuing to make new all-time highs, and this isn't even predicated on that expectation of the 6 rate cuts. I mean, we'll get 1 to 3 if we're lucky this year, but it feels as if things have been moving on the fundamentals, which in my mind is more encouraging rather than just predicating on guessing what the Fed is going to do. And that's why I feel like now that we're getting into that earnings vacuum and hyper focusing on what's happening with the Fed, I'm curious to see how the equity and fixed income markets digest this.
Well, just to jump on that. Go real quick, Dan. I want to jump on that. Earnings season was better than expected. We saw more beats and we saw encouragement. So I think the fact of the matter is that the economy is still strong. I know there's a couple of recessionary risks out there, and you can talk about why is Apple coming off, and we're seeing in the video. There's all these different indicators that people are getting nervous about, and there's always going to be recession coming. We know that as managers, but nonetheless, it is fascinating to see that the strength of the economy, and remember, the economy is consumer driven, at least by 2/3. So I think there's more room to run. And I don't think the Fed is really going to throw a wrench into the machine here inside of this election year.
Well, again, I'm just going to follow up on that. And yeah, there's no question when you look at just the general trends in the data, even when the Fed reached its peak last year, I guess, certainly they anticipated they'd probably be cutting by now, I think. But if you look at the strength of the economy, even with rates holding at decades highs, that I think they're a little bit astounded as well, and they'll be fine with that. Again,
and I think that's something
the labor market continues to stay strong, even in today's data, and the wage inflation is trending lower, sideways to lower, and we continue to see really overall the consumer remaining strong. The one caveat would be manufacturing, and then now we've had a couple of service data points that are coming in a little bit lower than expected, but overall, as long as the economy maintains this trajectory, GDP, why would the Fed cut? I mean, really, if you look step back, why would they?
It's a great point you bring up, and that's hitting the nail on the head, and it's not being talked enough about. The Fed is trying to say, look over here, we don't have our inflation target at 2% yet, but we know the Fed has continually moved the goalpost on their inflation target. So I think they are concerned about the strength of the economy. They certainly look to see where the S&P 500 is trading, and all these new all-time highs gives them a little bit of reason and cover to say, oh, we're just not there yet on our inflationary target. We want to be more prudent and not cut rates. The one thing we know about the Fed, they've notoriously been late to the game, but I really think they have more prudence in cutting rates here. If they saw some crack in labor markets, maybe they did today, seeing the unemployment rate from 3.7, 3.9. If they see further cracks or reasons to cut rates, they will, because they don't want the economy to all of a sudden seize up. They want to pull off
Right.
this soft landing. But I think Dan's absolutely right that the strength of the consumer continues to astonish them, despite the fact that we're in such a restrictive zone with rates.
Yeah, and that's a great point that you bring up too, right? Do you want to just do a rate cut for the sake of doing? I don't know. I feel like I'd be more comfortable with a strong economy, consumer doing well. Everybody has a job that for the most part wants to have a job. I feel like if I had to pick one or the other, or a stronger economy versus a 25 basis point rate cut, I mean, how much will that really move the
And
needle?
the Fed could really be, the Fed could really be in a predicament if they cut rates by, let's say they cut rates by 100 basis points, which I'm not in that camp anymore. Let's just say they do. They could fuel the stock market to go another 10 or 15% higher. And now they can't get the toothpaste back in the tube, and they'd have to really mechanically cut rates by 50 to 75 basis points to cool, they'd have to keep rates up by 50, 75 basis points to cool off what they've done or created. So they're in a bit of a conundrum here where you're right, Jill. If they cut interest rates, that may just put more of that cash sitting on the sidelines into the stock market.
Mm-hmm. All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.